We are taught that wealth is solid. It is land, it is gold, it is brick and mortar and coin. It is something that can be counted, held, and locked away. Yet history's greatest economic collapses present a stark, bewildering paradox. Trillions in market value can disappear into thin air overnight, leaving behind no physical trace. This is the central contradiction of modern finance. The cognitive dissonance between the tangible world we inhabit and the spectral economy of valuations that floats above it. If wealth is real, how can it simply vanish? Where precisely does it go? Our story begins not on the digital trading floors of Wall Street, but in the painted halls of the first true stock market, where the ghost of lost fortune first made its appearance. The quest to track this phantom capital through the centuries reveals the fragile architecture of our entire economic system, built not on stone, but on a shared and volatile dream. The Amsterdam Exchange of the early 1600s was a temple to this new, intangible faith. Here, the Dutch East India Company issued shares that were not mere slices of a ship's hull or its cargo of spices, but pieces of future profit, of imperial ambition, of potential. Their value was a collective agreement, a story told by brokers and believed by a nation. As the Tulip Mania would soon demonstrate, price could detach completely from any earthly object, soaring on the winds of speculation. The wealth generated was spectacular, funding canals and masterpieces. But it was, from its inception, spectral wealth, a ledger entry, a belief. When the belief shuddered, the wealth would prove to have no home, no vault to retreat to. It was already gone, because it had never been here in the way a tulip was. This concept of evaporative value challenges the very foundation of classical economic history. Adam Smith spoke of the wealth of nations residing in their productive labor and goods. Yet, the financial markets that evolved after his time created a parallel universe of wealth, one measured in stock prices and derivatives, a universe where value is a momentary consensus, as insubstantial as a rumor. A market crash, therefore, is not the destruction of factories or farms. It is the sudden, violent dissolution of a story. The numbers on the screen shrink, and in that mathematical adjustment, lifetimes of paper gains are obliterated. The money did not go anywhere. It ceases to be recognized as having existed in the first place. To track the ghost, we must follow the chain of promises. When you buy a stock, you pay real money to a former owner. That money changes hands and is spent or invested. The wealth you now hold is not that cash, but the expectation that someone else will later pay you even more. The entire structure is a dizzying, inverted pyramid of such expectations, each layer trusting the one below it will hold. In a bull market, this feels like solid ground. In a crash, it is revealed as a hall of mirrors, each reflecting a now broken faith. The catastrophic financial collapse of 1929 did not burn down America's factories on Black Tuesday, but it shattered the mirror of future expectation, freezing credit and turning vibrant businesses into hollow shells overnight. Thus, the ghost's first haunting ground is psychology. The wealth exists only as long as a critical mass of minds agree on its existence. When fear erodes that agreement, the valuation, the ghost, flees. Our journey through economic history is a hunt for this phantom through its most infamous manifestations, from the South Sea bubble's enchanted ledgers to the dot-com era's evanescent pixels. We will see that each crisis is a painful lesson in the same truth. A great portion of our wealth is a shared illusion, magnificently potent when sustained, and utterly, devastatingly null when the dream ends. The market crash is the moment we all wake up and find the treasure chest filled with nothing but air. The ghost needed a birthplace, a system to give its fleeting form a semblance of permanence. This was invented not in a stock exchange, but in the quiet scriptoria of medieval Italian bankers. Here, the ledger was born, and with it, the alchemical process of turning trust into tangible power. The innovation was deceptively simple. If a merchant in Florence deposited 100 gold florins, the bank did not merely guard the coins. It issued a paper promise for that amount, which could then be transferred to another party to settle a debt. That paper promise began to circulate. Critically, the bank, realizing not all depositors would demand their physical gold at once, could lend out a portion of the coins to another entrepreneur, collecting interest. The original 100 florins now existed in two places at once, as a credit in the first merchant's account and as physical capital in a trader's hands. Money had been, effectively, created from trust. This was the primal split between real and spectral wealth. The physical gold was finite, constrained by mines and mints. But the credit in the ledger, the ghost money, could expand infinitely, limited only by the banker's courage and the community's faith in his integrity. The wealth of nations began its slow migration from the treasury vault to the banker's book. This financial innovation powered the Renaissance, funding voyages and artworks. Yet, it installed a fatal vulnerability at the heart of economic growth. If faith in the bank wavered and depositors all demanded their gold back in a run, the spectral wealth would vanish, exposed as a promise that could not be kept. The ghost could giveth, and the ghost could taketh away. The system evolved with bills of exchange, sophisticated debt instruments that allowed merchants to move vast sums across Europe without the peril of transporting chests of coin. This network of promises became the lifeblood of continental trade. But it also meant that the failure of a single major merchant in Seville could trigger a cascade of broken promises, a contagion of vanished credit that bankrupted perfectly sound businesses in Antwerp and Lyon. The 1763 crisis, triggered by the collapse of the Amsterdam banking house de Neufville, was a textbook example. Real goods existed, ships sailed, but the circulatory system of credit that connected them ceased. Wealth evaporated across the map, not from pirate raids, but from erased lines and ledgers. This era cemented the dual nature of capital. There was fixed capital, the ship, the loom, the warehouse. And there was circulating capital, the money, and, more importantly, the credit that set these objects in motion. Economic historians note that it was the explosion of this circulating, spectral capital that fueled the Industrial Revolution. Factories were built not from saved gold, but from promissory notes and bonds, from the belief of investors in a future yield. The wealth was forward-looking, a bet on tomorrow. The stock market formalized this bet, turning companies into collections of traded promises. Each cycle of boom and bust that followed was essentially a test of the system's ability to sustain the dream against the harsh realities of overproduction, war, or simple human frailty. Thus, by the dawn of the modern era, the ghost was fully institutionalized. It lived in the bond market, the banking reserve ratio, and the share certificate. It was the indispensable engine of progress and a perpetual source of systemic risk. The ledger, a tool of magnificent creation, had also become a prison of mutual dependency. When the dream in the ledger grew too detached from the productive assets it was meant to represent, a reckoning was inevitable. The stage was now set for the ghost to make its most dramatic and destructive public appearances, leaving not just merchants ruined, but entire societies transformed in the wake of its sudden departure. If credit is the ghost's breath, then a speculative bubble is the moment it materializes, puts on a crown, and demands everyone pay homage. History's great bubbles are case studies in mass psychology conjuring phantom wealth out of pure narrative. They answer our provocative question with chilling clarity. The money goes into a collective hallucination of value, sustained only until the story breaks. The Dutch Tulip Mania of 1637 is the purest example. A single Semper Augustus bulb at its peak could trade for the price of a grand canal house. This was not a valuation of the flower's beauty, nor its utility. It was the price of a position in a frenzied game of greater fools, where wealth was a ticket passed to the next player. When the music stopped, the ticket was worthless. The canal house never moved. The spectral fortune attached to the bulb simply ceased to be. The South Sea bubble of 1720, painted in the grand oils of economic tragedy, elevated the ghost to a matter of state. The South Sea Company, granted a monopoly on trade with Spanish America, was in reality a complex financial engine designed to consolidate and monetize the British government's debt. Its stock became a vessel for wildest fantasy, visions of boundless South American gold. As the share price skyrocketed, it created paper fortunes for the elite who got in early. This wealth was used as collateral for more loans, which poured into other frivolous ventures, multiplying the ghosts. The economist's view reveals this as a massive inflation of the financial sphere, detached from the underlying, sluggish real economy. When the promised trade failed to materialize, the narrative collapsed. The ghost wealth vanished, but the debts incurred to acquire it remained solid and crushing. Across the channel, John Law's Mississippi bubble in France performed the same feat with even more disastrous consequences. Law, a financial theorist, understood the ghost perfectly. He convinced the French Regency to replace gold-backed currency with paper money issued by his bank, backed by the supposed vast wealth of the Louisiana Territory. He created a company with a monopoly on this colonial trade and orchestrated a spectacular rise in its share price. For a brief, dazzling period, paper millionaires crowded the streets of Paris. The economy seemed reborn. But the wealth was entirely spectral, a confidence trick built on exaggerated colonial prospects and an ever-expanding money supply. When savvy investors tried to convert their paper profits back into tangible land or gold, the system imploded. The ghost evaporated, leaving the French economy and the monarchy's credibility in ashes. These bubbles are not mere historical curiosities. They are foundational templates. They demonstrate the critical mechanisms of phantom wealth creation, a compelling narrative, new trade, new technology, easy credit or money creation to fuel speculation, and the powerful social proof of seeing others get rich. The wealth generated feels utterly real to those experiencing it. It buys influence, estates, and status. But it is wealth without a corresponding increase in productive capital. It is an inflation of financial claims on a static or slowly growing base of real assets. The crash, therefore, is not a transfer but an annihilation. The financial claims are repriced to zero or near zero. The ghost returns to the ledger from whence it came, leaving behind only the wreckage of leveraged bets and broken lives. Understanding this pattern is crucial for dissecting modern market crashes. The dot-com bubble, the housing mania, each is a new costume for the same ancient specter. The object of speculation changes from tulip bulbs to internet domains to suburban mortgages, but the underlying dynamic of narrative-driven, credit-fueled value inflation remains. The ghost takes a new form, we give it a new name, and we convince ourselves, each time, that this time it's different. The history of economic collapses is the history of forgetting this lesson, of allowing the dream in the ledger to grow so vivid that we mistake it for the world itself. The industrial age gave the ghost new, colossal bodies to inhabit. Continents of railroad iron, forests of telegraph poles, mountains of coal and steel. The Panic of 1873, a global economic depression that began in Vienna and struck with ferocity in the United States, revealed how phantom wealth could be conjured not just from colonial fantasies, but from overbuilt, debt-soaked reality. This was the gilded ghost, wealth that appeared solid as a railroad spike, but was in fact a precarious mountain of bonds, stocks, and speculative land grants. The post-Civil War boom in America was built on a railway mania. Thousands of miles of track were laid, financed by complex securities sold to European and domestic investors dreaming of undawn profits from a connected continent. The wealth created was staggering on paper. Railway stocks soared, making instant barons of the robber industrialists. Towns sprung up along proposed routes, and land values skyrocketed in anticipation. This economic growth, however, was fueled by an unsustainable pyramid of credit. The railroad companies were often overcapitalized, their stock and bond issuance far exceeding the realistic revenue the lines could ever generate. The wealth was, once again, the expectation of future monopoly profits. But as tracks reached beyond the profitable East into the sparsely populated West, and as competition between lines grew vicious, those profits failed to materialize. The ghostly portion of the valuation, the speculative premium, grew ever larger. The trigger was the failure of J. Cook and Company, a premier American bank heavily invested in the Northern Pacific Railway's bonds. When Cook could not sell more bonds to fund the railway's relentless and unprofitable expansion, he collapsed. The failure was a lightning strike that ignited the over-leveraged financial landscape. Credit, the lifeblood of the Gilded Age economy, froze instantly. Railway projects halted, leaving literal half-built bridges to nowhere. Mills and factories, dependent on railway transport, shut down. The paper fortunes of the railroad magnates evaporated, but the debt, the bonds held by pension funds, banks, and individuals across the world, remained. The ghost fled, leaving the crushing weight of its unrealized promise behind. This crisis introduced the modern phenomenon of a debt deflation spiral, a key concept in economic history. As businesses failed, they laid off workers, who then could not pay their debts or buy goods. Prices for commodities and assets plummeted. This made the real value of existing debts increase, crushing borrowers further and leading to more defaults. It was a vortex where the disappearance of spectral wealth actively destroyed real, tangible wealth. Farms were foreclosed. Factories were shuttered not because they were unproductive, but because the financial system that supported them had been poisoned by bad promises. The ghost's departure sucked the very air out of the real economy. The long depression that followed, lasting nearly a decade, was a brutal lesson in the interconnectedness of global finance and the perils of asset inflation. The ghost wealth built on American railroads had been funded by European capital. When it vanished, it triggered bank failures in London and Vienna. The crash demonstrated that in an industrialized, financially sophisticated world, the phantom could grow to such immense scale that its disappearance could cripple nations. The Gilded Age's gleaming surface of progress was shown to be underpinned by a cavernous, unstable foundation of credit. The hunt for the ghost now had to contend with its most powerful incarnation yet, not a story about a far-off land, but a story written in steel and steam, a story so convincing that its collapse shook the world. The Roaring Twenties industrialized the production of phantom wealth. The assembly line that built Model Ts also built a new, mass-participation financial dream. The foundational innovation was buying on margin. For just a 10% down payment, any clerk or shopkeeper could own a piece of corporate America. This was leverage on a societal scale, a mechanism to conjure vast sums of speculative capital from modest savings. The wealth flashing on brokerage boards was, for millions, a real and exhilarating force. It paid for radios, refrigerators, and the down payment on a bungalow. But it was wealth built on debt, on the faith that the next buyer would pay more. The stock market was no longer just financing industry. It had become the industry, a self-referential machine for manufacturing financial value. This system created a feedback loop of illusion. Rising stock prices made investors feel richer, so they borrowed more to buy more stocks, driving prices higher still. Corporations used their inflated stock as currency to buy other companies, creating massive, debt-laden trusts. The underlying economy was strong, but the financial superstructure grew at a delirious, detached pace. The price-to-earnings ratios of companies lost all connection to reality. Economic historians identify this as a classic credit boom, where the expansion of money and credit outruns the growth of goods and services, inflating asset prices. The ghost was no longer a specter haunting the edges of the economy. It was the economy's main attraction. The crash was the inevitable, brutal correction. When confidence finally wavered in October 1929, the margin calls began. A margin call is the ghost's debt collector. It demands real money to cover the evaporated paper value of the leveraged stock. Forced to sell to meet the call, investors flooded the market, driving prices down further, triggering more margin calls. It was a financial death spiral. The wealth didn't go to anyone. It was systematically liquidated, erased from existence by a mathematical imperative. Billions in market valuation were annihilated in days. The ticker tape couldn't keep up with the vanishing act. But 1929 was more than a stock market crash. It was the ghost escaping its financial confines and ravaging the real world. As portfolios vanished, consumption ground to a halt. Factories that had expanded to meet speculative demand now faced empty order books. Banks, which had lent heavily against stock collateral and to businesses, began to fail as loans soured. Each bank failure destroyed not just deposits, but the very records of debt and credit, the ledgers themselves, wiping out the community's financial memory and paralyzing local commerce. The Great Depression was the ghost's ultimate masterpiece, the annihilation of spectral wealth triggering a near-total collapse of tangible production, employment, and global trade. The lesson of 1929 is the catastrophic power of leverage in a democratized market. It proved that when the ghost of speculative value is invited into every home via easy credit, its departure can empty every home in turn. The wealth was always conditional, a loan from the future against the promise of perpetual growth. When that future arrived and failed to deliver, the loan was called in, with compound interest paid in human suffering. The search for the ghost now led policymakers to a desperate question. Could this phantom be caged, or at least placated by the power of the state? The answer would redefine the role of government in the economy for the rest of the century. The ghost found its most perfect, invisible medium in the digital revolution. The dot-com bubble of the late 1990s was the first crash of the information age, a spectacle where wealth was conjured from ideas about the internet rather than the internet's actual, early-stage utility. The narrative was irresistible: a new economy where old rules like profits and price-to-earnings ratios were obsolete. Value was now in eyeballs, market share, and network effects. A company with a clever domain name and a website could go public and see its stock multiply 100-fold on the first day, creating billionaires on paper. This was phantom wealth in its most abstract form. Valuations based on potential traffic and future advertising revenue. Metrics as ephemeral as the web pages themselves. The mechanisms were a high-tech echo of past manias. Venture capital flooded in, creating a land rush for digital territory. Startups burned through cash to acquire users, fueling a feedback loop where rising stock prices provided more capital to burn, justifying even higher prices. The wealth generated was used as currency for acquisitions, inflating the sector further. The wealth effect from tech stocks fueled consumer spending and lavish corporate perks, creating a vibrant, if surreal, economic boom in places like Silicon Valley and San Francisco. Yet, beneath the surface, the vast majority of these companies had no path to profitability. Their value was a shared story about a transformative future. The collapse, when it came in 2000, was a slow, brutal deflation rather than a single-day panic. As burn rates continued and profits failed to materialize, investor patience evaporated. The ghost, sustained by narrative, could not survive the quarterly reports of relentless losses. Stock prices didn't crash so much as they evaporated over months, like ice sublimating in a vacuum. Trillions in market capitalization disappeared. This time, the money didn't vanish from margin accounts as in 1929, but from the retirement funds and brokerage accounts of a new, online investing public. The companies themselves didn't just lose value. They ceased to exist, their assets often nothing more than office furniture and a defunct URL. The dot-com bust provided a critical lesson in economic history. Technological disruption, while real, does not suspend the laws of financial gravity. A revolutionary medium does not invalidate the need for a business to generate more cash than it consumes. The ghost wealth of the era was a massive misallocation of capital, funneling billions into redundant pet food websites and excessive fiber optic cable, while leaving other sectors starved. The aftermath saw a flight to safety and tangible assets, ironically helping to inflate the next bubble in housing. The digital apparition proved that the ghost could adapt to any era, wearing the mask of disruption and innovation to enchant a new generation. Furthermore, this crash highlighted the new, global speed of phantom wealth creation and destruction. Information and panic now traveled at the speed of light. Online brokerages and financial news networks amplified the mania and the despair. The ghost could achieve global scale and vanish with unprecedented velocity. The digital age did not banish the phantom. It gave it a faster, more pervasive network through which to operate, setting the stage for an even more complex and systemic haunting in the new millennium. One built not on ideas about the internet, but on the very bedrock of the global economy, the home itself. The ghost's most sophisticated and ultimately most devastating disguise was that of safety itself. In the lead-up to the 2008 global financial crisis, phantom wealth was no longer in speculative tech stocks, but in the world's safest asset, the American mortgage. Through the alchemy of financial engineering, risky subprime home loans were bundled, sliced, and transformed into AAA-rated securities, bonds that were sold to pension funds, municipalities, and banks worldwide as solid as government debt. This process, securitization, created a universe of new financial products. Their value was a complex mathematical story about diversification and risk models, a story few understood but everyone trusted. This was wealth creation on a stupefying scale. The demand for these mortgage-backed securities was insatiable, which in turn fueled a voracious demand for the raw material: more mortgages. Lenders abandoned standards, issuing ninja loans, no income, no job, no assets, to feed the machine. Housing prices, driven by this easy credit and speculative flipping, soared. Homeowners felt rich, tapping their home equity to spend. The financial sector's profits and bonuses reached historic highs, all built on the ever-rising value of these securitized bundles and the dizzying derivatives bets placed upon them. The global economy was intoxicated by a phantom wealth rooted not in tulips or railroads, but in the very concept of home. The wealth was, of course, spectral. The AAA ratings were a fantasy, a product of flawed models and catastrophic conflicts of interest at the rating agencies. The underlying home loans were increasingly destined to fail. When the adjustable rates reset and borrowers could not pay, the first domino fell. The complex, interlinked securities became impossible to value, then utterly worthless. The ghost here was not just the inflated house price, but the multi-trillion-dollar superstructure of derivatives and leveraged bets built upon it. Firms like Lehman Brothers were not holding bad mortgages. They were holding claims on claims on claims, a house of cards where the bottom card had disintegrated. The 2008 collapse was therefore a crisis of counterparty trust in a networked, opaque system. Banks, unsure of what toxic assets their trading partners held, stopped lending to each other. The interbank lending market, the circulatory system of the global economy, froze. This was the ghost's revenge. The phantom wealth had been so thoroughly woven into the fabric of finance that its disappearance caused the entire system to seize. The money didn't go. It was revealed to have been a systemic illusion, a mass hallucination of safety and value sanctioned by regulators, celebrated by markets, and sold to the world. The wealth vanished from balance sheets, pension funds, and retirement accounts from Reykjavik to Shanghai. This episode marked the apex of the ghost's evolution, from a simple ledger entry to a tradable commodity to an incomprehensibly complex derivative. It demonstrated that the financial system could now generate near-infinite phantom wealth internally, with only a tenuous connection to the real economy. The hunt for the ghost had led to the heart of the modern financial labyrinth, where it was no longer a singular entity, but a diffuse, toxic mist that had contaminated every corner of global capital. Containing this crisis would require not just liquidity, but the most audacious act of collective make-believe ever attempted by governments, to convince the world that the ghost could be resurrected and stabilized. In the smoking crater of 2008, the world's central banks faced an existential problem: how to revive an economy where the ghost of wealth had fled and taken the credit system with it. Their unprecedented answer was to become the summoners-in-chief. Through quantitative easing, QE, they created new electronic money, ex nihilo, to buy the toxic securities and government bonds from the stricken financial system. This was a direct intervention into the ledger, a forced reinflation of financial asset prices. The goal was explicit: to resurrect the ghost of wealth, to make banks feel solvent and investors feel confident again, hoping this wealth effect would trickle down to the real economy. The spell worked, but in a profoundly distorted way. The newly created money flooded into financial markets, not Main Street. It drove a historic, decade-long bull market in stocks and bonds. Asset prices soared, creating immense paper wealth for those who owned them, the already wealthy. Inequality widened into a chasm. The phantom wealth was back, but it was now officially sanctioned, a creature of state policy living on central bank balance sheets that ballooned to unimaginable sizes. The ghost was no longer a market accident. It was a permanent, managed feature of the system. The Federal Reserve's balance sheet, a ledger of its assets, became the sacred scroll where the modern ghost primarily resided. This era created a new economic paradox: soaring financial markets alongside sluggish wage growth and stagnant productive investment. Companies used cheap debt not to build new factories, but to buy back their own shares, further inflating stock prices. The link between the health of the stock market and the health of the broader economy, never perfect, grew dangerously attenuated. The wealth on screens was real for portfolio owners, but it was a wealth increasingly detached from the engine of job creation and productivity. Economic historians will debate whether QE saved capitalism or created a monstrous, liquidity-addicted version of it, where every sneeze in the markets demands a new central bank intervention. Furthermore, QE globalized the managed ghost. The European Central Bank and the Bank of Japan launched their own, even more aggressive programs. The world was awash in cheap capital searching for yield, inflating asset bubbles everywhere from Shanghai apartments to San Francisco tech valuations. The ghost became a globalized, monetary phenomenon, its movements dictated by central bank meeting minutes rather than organic economic growth. The question, where does the money go, now had an unsettling answer. It goes where the central banks direct it, and it stays there trapped in asset prices because the fear of letting the ghost escape again, of another 2008, is too great. We now live in the world this summoning created. The ghost is a domesticated but bloated presence, woven into the fabric of every pension fund and institutional portfolio. Its existence relies on the continuous belief that central banks, the modern wizards of the ledger, will not let it fail. This has led to a pervasive moral hazard, where financial risk-taking is encouraged by the promise of a bailout. The hunt for the ghost has reached its final, bizarre stage. We have tracked it to the central bank and found it living there by design, fed a diet of digital currency. But this raises the ultimate, terrifying question. What happens when the summoners lose control, or when the spell itself begins to warp the reality it was meant to stabilize? Just as central banks sought to institutionalize the ghost, a new, anarchic strain of phantom wealth erupted from the digital shadows: cryptocurrency. Bitcoin's founding myth was a direct rebellion against the summoned ghost of fiat currency. Its narrative promised a wealth beyond the control of central bankers, a hard digital money with a verifiable, algorithmic scarcity. Its value was pure story, trust in code, decentralization, and a libertarian ideal. The wealth created from this story has been astronomical, birthing paper billionaires and a sprawling ecosystem of altcoins, decentralized finance, DeFi, and non-fungible tokens, NFTs. This is the ghost attempting to create its own sovereign nation, built on blockchain ledgers rather than state authority. The crypto bubbles of 2017 and 2021 are pristine examples of narrative-driven value creation in the digital age. Dogecoin, a joke currency, achieved a multi-billion-dollar valuation. NFTs of digital art sold for millions, their value residing entirely in a verifiable but intangible receipt of ownership on a chain. This wealth feels real to its holders. It buys yachts and political influence, but it exists in a realm even more abstract than traditional finance. It is a ghost claiming it is more real than the fiat ghost, a metaspectre whose value is consensus about the supremacy of a new technological paradigm. Its volatility is a feature, a constant reminder of its purely psychological foundations. This movement forces a fundamental economic history question. What is the ultimate backstop of value? For centuries, it shifted from tangible commodity, gold, to state promise, fiat currency, to the managed expectations of central banks. Crypto proposes code and decentralized consensus as the new backstop. Yet, the spectacular collapses of entities like Terra/Luna and FTX revealed the same old ghosts wearing new masks: leverage, fraud, interconnectedness, and the catastrophic power of broken trust. The algorithmic stablecoin was revealed as a leveraged bet. The centralized exchange was a fractional reserve bank in a hoodie. The phantom wealth vanished in a digital instant, proving that no technology is immune to human frailty and the laws of financial gravity. Crypto represents the frontier of the ghost's evolution, a deliberate attempt to build an economy on spectral foundations from the ground up. It is a live experiment in whether wealth can be permanently and stably housed in pure belief, secured by mathematics rather than institutions. For economic historians, it is a fascinating return to first principles, a digital restaging of the early days of banking and fiat money, but at internet speed and global scale. Whether it becomes a lasting parallel system or collapses under the weight of its own contradictions, it underscores a persistent human drive to find new vessels for the ghost, new stories to tell about value when the old stories lose their power. As we look to the future of markets, from AI-driven trading to potential central bank digital currencies, CBDCs, the ghost's nature will continue to morph. AI may create new, unfathomable patterns of speculation. CBDCs could give the state-sponsored ghost a direct, programmable link to every citizen. The eternal hunt continues. The lesson of the last 400 years is not that phantom wealth is evil or avoidable. It is the engine of growth in a credit-based system. The lesson is that we must forever be vigilant of the story we tell about it. When the story grows too far from any anchor in human productivity, utility, or ethical constraint, the ghost grows too powerful. And when it flees, as it always does, it leaves a colder, harder reality in its wake. So, where does the money go when the market crashes? We have tracked the ghost from Amsterdam to Wall Street to the blockchain, and the answer is now clear. It goes nowhere, because it was never there in the way we imagined. The money that vanishes is not a physical substance, but a shared assessment of future potential, a valuation. A crash is a violent, collective revision of that story. The wealth disappears from the ledger of present expectations, returning to the void of unlived tomorrows. It is a correction not of atoms, but of assumptions. This spectral wealth, however, is not a mere illusion. It is a powerful social force, the very catalyst for building the tangible world. No railroad, no internet, no modern city was built from saved gold alone. Each was built from credit, from stocks, from bonds, from the ghost's promise. Our economic history is therefore a permanent haunting. The ghost is the necessary spirit of capitalism, the risk-taking, future-oriented belief that turns ideas into iron and code. The cycle of boom and bust is the ghost's breath, inhaling confidence, exhaling fear. The great crashes, 1720, 1929, 2008, are not anomalies, but system-level purges, moments when the accumulated fiction of value outruns the capacity of the real economy to sustain it. They are painful, necessary resets where the ghost is exorcised, only to be slowly summoned back by the relentless human desire for growth. The key to stability is not to kill the ghost, which would kill progress, but to manage its appetites and anchor its flights of fancy to something real. This understanding changes the question from where does it go to how do we live with it. Prudent financial regulation acts as a binding spell, ensuring the ghost cannot grow so large that its departure destroys the host. Central banks have become the ghost's reluctant keepers, a role with immense power and peril. Financial literacy is a form of personal exorcism, allowing individuals to see the spectral nature of paper gains and to build resilience on tangible skills and diversified assets. Recognizing that a great deal of our celebrated wealth is a shared dream tempers our hubris and should inform every investment, every policy, and every personal financial plan. As we stand on the brink of new eras of artificial intelligence, climate transition, and monetary innovation, the ghost will take new forms. The narratives will be about quantum computing, carbon credits, or Martian real estate. The same dynamics of story, credit, and psychology will apply. The hunt never ends. The final revelation of this long search through economic history is that the ghost wealth of nations is us. It is our collective faith, our fear, our greed, and our hope, quantified and traded. It is a mirror reflecting the state of our belief in the future. When the market crashes, the money doesn't go to another place. The faith simply leaves the room. And we are left, once again, with the sobering, liberating task of deciding what to believe in next. The phantom that haunts our markets is not a foreign specter, but a reflection of our own collective psyche, our capacity for dazzling faith and paralyzing fear. It is the story we tell ourselves about tomorrow, given a price today. This story has built our world, and its sudden revisions have shattered it. The ghost cannot be banished, for it is the very engine of economic growth. But it can be understood. To navigate a world of spectral wealth, you must become a student of its history and its psychology. You must learn to distinguish between the solid ground of productive enterprise and the shifting sands of pure speculation. This is not just a lesson for investors, but for every citizen. In an age where our pensions, our currencies, and our very livelihoods are intertwined with these global phantoms, financial literacy is a survival skill. It is the light that allows us to see the ghost for what it is, a powerful, indispensable, and potentially treacherous force of our own creation. What is your story of value? Does it rest on the shifting consensus of a crowd, or on something more durable? The next time you see a headline about markets soaring or crashing, look past the numbers. See the ghost. Understand the narrative driving it. Question the consensus. Study the past to protect your future. The history of economic collapses is a repeating echo, not of doom, but of warning and opportunity. The ghost will return. The question is, will you be its victim, its bystander, or its aware, respectful master? This has been the ghost wealth of nations. The hunt continues.